This week on the Danny Moses Show, I'm going to talk about what seemingly is becoming a lost art these days, short selling, and why I believe it plays an important role in the markets. Forget what you think. I'll tell you what to know. I'm excited to welcome the founder and CEO of Trivariate Research, Adam Parker, to the show. With over 25 years of Wall Street experience, he will make us all smarter. And it's Super Bowl week, so you can expect some predictions in the form of Kalshi event contracts. And yes, I have lots of them.
Over 30 years of beating Wall Street, predicting the famous Big Short. Now, he's here for you. This is the Danny Moses Show.
Welcome to the show. Every week, we will help make sense of the most important and impactful events happening in the markets, and I will do my best to break it down for you in a way that both informs and entertains. That's what you can expect here on Scripps News, so let's get to it. I'm known as one of the guys from the Big Short, and when you hear the word short or going short as it relates to a stock, most people cringe or become uncomfortable at the thought of somebody benefiting from a decline in a company's shares at the expense of owners or longs in those stocks. But short sellers can provide more grease and keep the gears turning. Without them, there would be less volume and liquidity. As a matter of fact, there are many fixed income investors that own corporate debt who short the underlying stock of the company to hedge out their risk. Without this ability, there might be fewer opportunities for companies to raise capital. So how does an investor short a stock? First, they need to locate the shares they intend to borrow through a broker using a margin account. They then sell the stock with the understanding that at some point in the future, they will buy back those shares at what they hope is a lower price than where they sold them and book a profit. Sell high and buy low versus the traditional buy low and sell high mantra. Of course, there is a cost of doing this, and we call that the borrow rate or cost to borrow. This cost varies widely depending on how many shares of stock have already been lent out relative to what shares are available. In other words, if there's a lot of demand to short a stock, the borrow rate is higher. That cost can range from almost nothing to an annualized rate of over 1,000% for hard-to-borrow, volatile stocks, and these fees can adjust daily. The measure of how many shares are short versus the public available float is called short interest. Let's say a company has 100 million shares of publicly traded stock. If there were 25 million shares short, the short interest would be 25%. There is another cost of shorting as well that is often overlooked. The short seller is also required to pay any dividends that occur while short the stock, so these costs can start to add up. This is why short sellers don't always have the ability to be long-term investors, like investors who buy a stock and put it away. Now let me address what was and still is a very controversial event that happened a few years ago during the meme stock craze in 2020 and 2021. There were several companies making big moves, such as AMC and GameStop, where the Reddit crowd, as they were called, formed a community that stood behind and began buying shares and call options in companies they felt were either experiencing improvements in their business or were being undervalued based on future prospects. To the moon was the mantra, meaning send the stock price soaring. Some of these stocks and their stock prices took on a life of their own, and the focus was not just on the fundamentals of these stocks, but the technicals as well, which included things such as targeting short sellers and short interest. The cost to borrow GameStop shares reached 99.5% in 2021. While short selling has rules and is regulated by both the SEC and FINRA, there have been times when the amount of shares short surpasses the amount of shares that are publicly traded. How is that even possible, you might ask? It's called naked shorting, where the shares are sold or shorted without having been properly borrowed. While there is an exception given to market makers in order to provide liquidity, this was a source of great controversy that happened around GameStop craze in early 2021. There were over 60 million shares short on a public float of only 45 million. The volatility that ensued forced Robinhood to halt trading of GameStop in late January 2021 as the collateral they were required to post in order to settle trades became untenable. It was also responsible for massive losses at a hedge fund, Melvin Capital, which ended up shutting down in 2022. After both congressional hearings and investigations by the regulators that followed the incident, Robinhood paid fines to both FINRA and the SEC as part of a broader settlement, but investors were still left with many unanswered questions. The interesting thing about short selling and why owners of stock should welcome their existence and the discourse is that barring a bankruptcy or liquidation in a company's stock, these shares will be bought back at some point in the future and provide support to the share price at a certain level. It can also provide powerful ammunition in the form of a short squeeze when a company's prospects improve and/or a short seller's thesis is proved incorrect. And just to be clear, it is illegal to fabricate a story surrounding a company for the sole intention of manipulating its price, higher or lower. We call that pump and dump when promoting a stock, or dump and pump in the case of spreading false narratives with the intent of driving a stock lower. So what can you do if you find yourself long or owning a stock that is coming under selling pressure from short sellers? Do yourself a favor and try and find out what the short seller's thesis is and the reason behind shorting the stock. And if you disagree with it, then use that selling pressure as an opportunity to buy more shares, and in some cases, you can also lend out your shares through your broker and get paid for that as well. It's always great to hear both sides of a story. Another good thing about short sellers is they can dig deep and uncover some issues that were either unknown or misinterpreted and bring them to light. For better or for worse, we have entered a period of deregulation in the financial sector, and with that may come less oversight and enforcement from both the SEC and the DOJ. It is more important than ever that investors do as much as they can to both inform and protect themselves, including hearing a bearish point of view. So don't believe everything you've heard about short sellers. They play detective and can sometimes bring issues to light. They provide liquidity to the markets and can act as a reality check, and they even play a role in the bond markets. When we come back, I'll sit down with Adam Parker, founder and CEO of Trivariate Research. With over 25 years of market experience, we'll talk about what he's watching right now. But first, here was my immediate reaction a week ago as President Trump nominated Kevin Warsh to lead the Federal Reserve.
We just named a new Fed chairman today. You know that? He's a central casting. He's like Roger Penske, central casting.
What does it mean? What does this decision mean for consumers and even small businesses?
Nothing's really changed overnight. Again, I think it'll be data dependent. A lot of news out there about K-shaped economy keeps getting stretched. The wealthiest people in the United States are controlling the majority of the economy and experience the benefits of the stock market, while the lower part of the K is not. I don't think that changes right now. But again, longer term, if you can anchor inflation expectations, that's a positive for all consumers, even if it means higher rates in the short term.
The Danny Moses Show is sponsored by Kalshi.
Welcome back to the Danny Moses Show. It's a pleasure to have Adam Parker join me. Adam, thanks for coming on the show.
Congrats on the show. Thanks for having me.
So let's start with your background, your years on Wall Street. We worked kind of nearer together a few times. What led you to start Trivariate and Trivector Research?
Yeah, so I have a PhD in statistics, and I got hired in the late 90s at a boutique firm called Sanford Bernstein, and I just kind of fell in love with researching stocks, and I've spent really my whole career focused on either investing in or researching U.S. equities. And so Trivariate is the culmination of that. We started the business for institutional investors in 2021, focusing on advice on U.S. equities. And then last year we started a business called Trivector Research, which is really just for individuals and advisors who want to know, get insights about the stock market.
That's great. All right, so we're a month into 2026. Feels like we've been trading for a year already.
Yeah.
You came in with your outlook kind of 2026. You've nailed a lot of stuff, obviously, here. What's been different than you thought? Is the market overreacting here? And what do you kind of guide investors here to kind of stay the path?
Look, I mean, after 3 monster years in the U.S. equity market, it's hard to kind of look at history and say, I'm expecting 5 more monster years in a row. Like at some point, the market starts to discount all the amazing technology from AI, and I think that's the biggest debate is, when will we see the benefits on productivity from AI in the corporate earnings? So it came into the year with that being, I think, one of the biggest controversies, how we see the capital spending from the big companies. As we're talking now, people are still digesting Google's numbers and their huge CapEx numbers. So that's definitely one big debate. I think the second is the Fed, as you just were talking about in your show last week. What does a more dovish Fed mean for equities? So those are probably the 2 main issues. And I come out on it thinking maybe the market's got a little less upside than the consensus view. As you know, everyone came into the year really bullish, both top down and bottom up. And I think we're in for more of a choppy mid-single digit year and not like a high double digit year, just based on where we are in the cycle.
Well, there's a lot of noise in the macro that's been going on. People have kind of tuned that out to focus on earnings. So we sit here today, we're about halfway through earnings season, maybe almost, and you actually said this in your note, that companies that are actually beating earnings are selling off and companies that are missing in some cases are going higher. That's because the market likes to project what's going to happen in the future. Right. We're seeing that happen right now in technology and software as we sit here. So go into that a little bit more. And you just talked about the AI trade here. Bring that full circle here to what we're seeing.
Yeah,
right now.
I think that the software is something you want to avoid. That's been our call kind of. And the reason is we went back the last 8 times software sold off this much over like a rolling 6-month period, because it really started in the middle of last year with some of the bigger names like ServiceNow and Intuit and Salesforce, et cetera. And then you study in the past when they've gone down this much what ultimately happens, and what ultimately happens is their earnings miss. So for people to say, well, I just want to buy these things because they're down a lot and they're mean reverting, I don't know if it's that easy. I want to wait and see, how much the downward revisions are. And if you're using a valuation is so compelling, I don't care argument, some of these software companies are still not that cheap in absolute terms. If you look at like a ServiceNow, for example. So I think, you don't want to catch the falling knife yet and just saying, oh, I'm going to, kind of play for a dead cat bounce. I don't love that idea. I think you still want to be cautious. I think you and I are going to be able to be coding experts in 2 or 3 years. We're just going to talk to our computer and tell it what to code. Yeah. And if that's where we're heading, it creates some risk around these entrenched software companies. If you and I were CEO of a huge company, we would look and say, who are we paying lots of money to, and can we somehow fix that in a 3 to 5 year view? And I think that's why the software companies act bad, because there's some concerns about their long-term value.
Yeah, you got Anthropic with Claude, I think, is what is really causing issues here.
Totally.
And so when you look at the software stocks, just want to go back to this for a minute. Some are participating in it, and some might get disintermediated out, right? So you're seeing kind of two groups. You're seeing the hyperscalers and all that stuff happening. Talk about that a little bit. Just break that down just a little bit more.
Sure.
If you could.
Yeah, I think that our main view is the big companies. People call the hyperscalers the grade 8 or how people refer to them. I think you have to own at least a market weight in them. They're around 38% of the S&P 500, but if you account for their bounce or their beta.
So let's talk about that. That's Google, that's Amazon. Let's talk about people that are.
Google, Amazon, Microsoft, NVIDIA, Broadcom, Apple. If you're making a bet there that they're going to underperform, you're saying, I think that there's going to be a total shift in how the market trades. Those companies combined, the grade 8, are forecasted to grow their net income nearly 30% this year. Their gross profits are going to grow. The rest of the 492 are expected to have declining gross profit dollars. And so I think the market usually rewards gross margin expansion. So I want to own a healthy dose of the hyperscalers. I think they can buy smaller companies. They can tack on technologies, and they're pretty well entrenched. So I would rather own them than take a shot at a falling knife software business like ServiceNow or Intuit or Salesforce.com, where I'm not 100% sure what their business looks like in 2035. And so that's sort of the pair trade I like. Look, our North Star, I'm a former semiconductor analyst, as you know. I covered semis for many years, and my North Star has been, I'd rather own Taiwan Semi than Salesforce.com, and I still think that is directionally true. Dead cat bounce trade or not.
So you've covered semis, so you know they're always cyclical.
Yeah.
We've been in a secular trade kind of here, and we talk about margins out there for something like an NVIDIA, which is in the mid-70s%. We know that over the long term, that's probably not sustainable.
Right.
So when you look forward, we go through these iterations of growth and secular. When does it become cyclical, in your opinion?
So I would kind of parse semis into sort of 4 groups. I'd start with memory, where the stocks have been the best. I mean, last year, I think 4 of the 5 best performing stocks in the S&P 500 were SanDisk, Micron, Western Dig, and Seagate. So memory shortage is massive. I know that business is cyclical, and I know that because the inventory, when you overbuild, it's the most perishable, meaning the pricing goes down the most. So right now, it's short. Stocks are to the moon. I think you have to be closer to selling the memory-related securities than buying them, even if we're going to have big upside earnings for the next 2 or 3 quarters, because we're not going to pay peak multiples on peak earnings for Micron. I think the second bucket is semi-cap, so things like Applied Materials, Lam Research, KLA Corp. I think ASML. I think those businesses may have more upside, even though some of them feed the memory business. They're not as expensive in absolute terms. Current fundamentals are pretty good. So I might overstay my welcome a little bit longer in the semi-caps. Then, as you mentioned, there's the direct revenue beneficiaries, NVIDIA, Broadcom, AMD, et cetera. And I don't think their multiples are going to expand. So if you want to own them, you're saying the growth is going to be good enough to offset multiple contraction. And then the fourth bucket, which I probably like the most within semis right now, based on how they act in the economy, are the industrial exposed companies. Microchip, Texas Instruments, Analog Devices. Those stocks are actually up a lot year to date. They're really good high margin businesses. And I think, as is typical, the stocks lead. So you saw ISM surprise to the upside. Well, we knew that based on Microchip's pre-release a month ago, because they sell into those industrial end markets. So I think I'm parsing semis a little bit more than just saying, hey, it's all to the moon and it's all cyclically correlated.
So as you sit here today, the market is obviously volatile to start the year. We're probably flat for the year as we sit here, maybe up slightly. But you're seeing a rotation, to your point, out of tech. And one of the things you do well is you screen for high quality stocks and places to go, sectors that have been ignored, whether it's energy, industrials, whatever it might have been. What are you seeing right now? What are your screens telling you where people should look to reallocate if they're thinking they're going to take money out of some
Honestly,
of these
my favorite sector is healthcare. And you know, we could parse that into a million buckets, but I would just start with the big picture of we have a lot of people that are aging, they require services, tools, diagnostics, hospitals, drugs, et cetera. A lot of healthcare businesses are really low margin. And so if AI is going to help at all in predicting employee and customer behavior, it's going to help drive up margins. So I like stocks like McKesson and Cardinal and Cencora and Quest and LabCorp and Thermo and businesses that I think demand will be steady. Healthcare S&P earnings have grown every year, 25 years in a row. There's no recession in people demanding those services. And I feel like the estimate achievability is pretty good there. It's a pretty good M&A sector, and I like the fact, as you point out, it's not really correlated to the AI trade. I mean, last year the biotech ETF was up 35%, so I think people are searching for innovation that isn't exactly tied to a potential AI overbuild.
How do you underwrite the regulatory risk? Just drug prices or premiums and so forth? How do you really?
I think that biggest issue is certainly that the government's a big customer for a lot of the companies. So it's hard to download the RFK Jr. discount as troughed or whatever, but it's certainly, healthcare was the best performing sector in Q4 in the S&P, and I think it kind of troughed in the middle of last year. Obviously that as a concern, but they were the worst performing sector the 2 years prior, creating the lowest relative multiples we've had in a quarter century. So I think my answer to that is I think it's in the price largely, and I always remember 10 plus years ago, Jamie Dimon at JP Morgan, Jeff Bezos at Amazon, Warren Buffett at Berkshire tried to create their own healthcare consortium, and then we stopped hearing about it. It petered out. So if those three guys can't figure it out, it's probably not that easy to replicate, and you're going to see probably steadier than expected demand over the next 2 or 3 years. So I like the productivity potential, and I'm not even talking about the mind-blowing stuff like faster drug development and computational chemistry and the AI, that piece. I'm just saying blocking and tackling margin expansion could drive multiple expansion for a lot of healthcare stocks, and it's certainly not the most crowded sector in the market.
Fair. One of the things I talked about on the show is the amount of U.S. government debt that's out there, and then you also have to factor in rates. How do you incorporate 10-year Treasury yields? Just kind of that is the one thing everybody looks at into your either stock screens or market thesis here.
Yeah, no, I mean, part of the reason I think I came into the year a little bit more cautious than consensus was really more the front end of the curve than the 10-year, which is, if you go back to 2022 when growth stocks got killed, the market got killed, it was all because the Fed was hiking, right? And eventually the great call was cover all your shorts at the end of 22 and get max long because the Fed's kind of almost done hiking, and I can anticipate accommodation. Part of me thinks we're 3 years later, and it's the mirror opposite now, where maybe cutting isn't going to be great anymore. And so I don't think the Fed can help as much the multiples, the price to earnings for equities as they did 3 years ago. I think that the long end's a little bit challenging argument. I'm going to take the view that the 10-year yield only goes up if the economy surprises to the upside, and it's been remarkably stable for the last year, the 10-year yield, despite the volatility in the equity market. So I think I'm comfortable that 10-year yield can back up 25, 50 bips, and the market can go up, as long as it's because growth is surprising to the upside.
Well, that's the key, the reason that it might go up. And I'm sure you run screens with yields at certain prices, and corporate debt obviously plays off treasuries, right, from the risk-free rate. So I assume you're watching spreads in that market continue, but totally. I think it's going to be something that's going to be obviously huge focus going forward.
I think financial conditions being loose is good for equities. So what you're really saying is what makes them tighten. And it could be something in the private credit space. It could be, as you point out, a balance sheet issue. But look, we studied at Trivariate really carefully the week-over-week change in the Fed balance sheet and the week-over-week change in the S&P 500, and they're really correlated. So if they're going to start doing stuff like expanding the balance sheet, you're going to have to be more bullish on equities. I mean, look at when the president said a month ago he might want the Fannie and Freddie to buy hundreds of billions of dollars worth of mortgage-backed securities. What happened? Every housing stock and home builder ripped higher 15% in 2 days. Even stuff like Home Depot and Lowe's, which are a little bit downstream. So I think it's hard to get too negative on rate-sensitive securities when the consensus view is the president is going to do what he can to make the economy better on housing and consumer spend into the midterm cycle.
Understood.
Yeah.
Well, Adam, how can people find your stuff? I know that you have websites that are out there. Maybe share
just go to trivectorresearch.com. So, TRI Vector. And if you say you watched on the Danny Moses Show, we'll give you a month free. So check it out.
There you go.
It's a win-win for everybody. And we do. I think what people like the most, besides the research and the ETF analysis, is we do monthly webcasts like this where people can ask questions. And I think it's very accessible. So yeah, we'd love for people to check it out.
Well, Adam, thank you so much for coming on the
show. I
show.
love seeing you, man. Congrats on the show.
I really appreciate it. Thank you so much. You can hang around for my Super Bowl picks coming via Kalshi event contracts, so stay tuned.
The Danny Moses Show is sponsored by Kalshi.
Welcome back to the Danny Moses Show. It's time for my Kalshi Picks of the Week, Super Bowl edition. Let's start with the game. You can take the Seahawks at 68 cents, and if you just win the game, you are paid out at $1. With a penny commission, that's 31 cents or a potential 45% return on your capital. Compare that to other money lines I see being offered on other platforms at something like a minus 238, which equates to a 42% return. And with Kalshi, I can trade at much better prices and all through the game as well. Secondly, while there is a good chance that if the Seahawks win, quarterback Sam Darnold will be the MVP, I don't like his price at 45 cents. That equates to roughly plus 117. I prefer the Seahawks running back Kenneth Walker III at just under 10 cents or roughly 10-1 to be MVP. While it's not common for running backs to be MVPs, the last one was Davis for the Broncos in 1998. I like those odds. And as another point of reference, Walker is being offered at under 8-1 on other platforms. And again, if he starts the game strong, you can trade out of the contract for a profit whether or not he ends up winning the award. Another event contract I'm looking at is for Patriots tight end Hunter Henry to have 4 or more catches. I see him as Drake May's security blanket in this game, and you can choose yes to 4 or more catches for 53 cents or just over even money. Lastly, under the mentions section for the Super Bowl on Kalshi, there is a trade that you can buy at 69 cents, which I'm taking, that pays 31 cents, so effectively a 43% return after commission, that either Mike Tirico or Chris Collinsworth, the announcers for the game, will say the word wind or windy at any point from kickoff to the last play. I find it hard to believe that between the extra points, the field goal attempts, and passing, that we won't get at some point, especially since the forecast is calling for some potential gusts, that we won't hear the words wind or windy called. Oh, and there's the fact that the NBC has installed a piece of technology called Weather Applied Metrics for the game, which measures the wind inside the stadium. Sorry, I had to throw that last one in. Remember, when you're trading on Kalshi, you're trading with other users similar to buying or selling a stock, and you can jump in or out of your position at any time to lock in a profit or cut your losses. So download the Kalshi app and use the promo code MOSES to get $10 when you trade $10. Back with my closing thoughts in a moment. Thanks again to Adam Parker for joining me on today's show. I hope you enjoyed this episode and got a better understanding of a short seller's role in the markets and why hearing both sides of a story can be helpful and informative. I also hope I gave you some Kalshi event contract ideas to make the Super Bowl even more enjoyable. I'll be back with you next week for another episode of The Danny Moses Show. In the meantime, you can follow me on various social channels, including on Substack, where me and my fellow Big Short partners, Porter Collins and Vincent Daniel, have What Are We Doing? Contrarians at the Gate, and watch our episodes anytime on scripsnews.com/Danny Moses and the Scripps News YouTube channel. So until then, I will keep an eye out in the markets for what everyone is talking about, what nobody is talking about, and what I think matters most to you. I'm Danny Moses.